Welcome to this explainer. Today, we're going to completely shatter this widespread myth that financial crashes are just these unpredictable, out-of-nowhere black swan events. Instead, we're going to prove they are deeply predictable economic cycles, hardwired right into the mechanics of our markets. If you want to figure out how macro capital flows actually work, and more importantly, how to bulletproof your portfolio before the next major downturn, you are in exactly the right place. Let's get into it. So are market crashes just random accidents? Well, most people, honestly, even a lot of seasoned investors, think market blowups are just that, totally random, like a lightning strike on a perfectly sunny day. But back in 1978, this brilliant economic historian named Charles Kindleberger published a literal masterpiece that flipped our understanding of market mechanics on its head. He proved that financial crises aren't random anomalies at all. They're actually a repeating, baked-in feature of free market capitalism. The huge takeaway here is that financial instability isn't just caused by some random external shock or, one bad government policy. It's generated right inside the financial system itself. It's this structural loop driven by human psychology, massive credit expansion, and leverage dynamics. And look, as long as human nature stays exactly the same, these cycles are going to keep repeating. Which is actually great news for us, because it gives astute investors a literal roadmap to navigate the chaos.
Moving on to Section 1, the three faces of market bubbles, based on Rosser, and Gallegati's findings.
So economists analyzing Kindleberger's work found something pretty wild. Bubbles don't all look the same on a chart. They actually show up in three distinct visual profiles. First up, you've got the type 1 parabolic spike. This one instantly collapses. Think of highly liquid commodities like crude oil back in 2008. Prices go basically vertical, and then boom, they drop right off a cliff. Then there's type 2, the symmetrical mountain. You see this with illiquid assets, like real estate from 2006 to 2010. Prices rise slowly and fall at that exact same agonizingly slow rate, mostly because sellers just refuse to take a loss overnight. And finally, type 3, the classic Minsky-Kindleberger cycle. We see this in equities and massive tech revolutions, and let me tell you, it is by far the most dangerous because of how perfectly it deceives investors right before the bottom falls out. All right, Section 2, the blueprint, the 5-stage anatomy of a crisis. Building on the work of monetary economist Perry Mehrling, we can actually dissect that third, super dangerous cycle into 5 totally predictable stages. You're going to want to burn these into your memory. Every major macro crisis follows this exact sequence. It kicks off with displacement. Then it accelerates into a boom. Next, it morphs into credit expansion in euphoria. After that, it quietly starts rotting during financial distress. And finally, it blows up in revulsion and panic. Let's walk through exactly what each of these looks like out in the wild. Okay, stage 1. It always starts with a displacement. Now, this isn't some fake rumor on a message board. It's a legitimate, massive, real-world shift. We're talking the end of a major war, sweeping deregulation, or a massive technological breakthrough, like railways back in the day, the commercial internet, or, artificial intelligence today. This structural shift drastically changes economic expectations and creates unbelievable new profit opportunities. And naturally, the smart money always swoops in early right here. Then we hit stage 2, the boom. Because those early investments are printing massive returns, this incredibly compelling narrative takes over. The optimism just sort of bleeds from the industry insiders right out into the broader public. And this is where George Soros's concept of reflexivity kicks into high gear. The rising asset prices actually change the real-world behavior of companies. Output, investment, and stock prices all surge at the exact same time, which makes the whole narrative feel completely validated. It feels real because, at that moment, it kind of is. Which brings us to stage 3, euphoria. Kindleberger had this brilliant quote, "There is nothing so disturbing to one's well-being and judgment as to see a friend get rich." I mean, how true is that? Watching your buddy make a fortune basically destroys all rational judgment. This right here is the leverage trap. You see, a boom doesn't become a full-blown bubble without insane credit expansion. Banks and shadow lenders start inventing totally new credit instruments, completely ignoring traditional reserves. Speculation just entirely replaces sound valuation. People stop caring about the actual cash flow an asset generates. They're just buying it for the capital gains, assuming there's always going to be a greater fool willing to buy it from them tomorrow. But the music always stops. Stage 4 is financial distress. Now, if you're managing risk, this is absolutely the most critical stage to watch. The market stops making dramatic new highs, but, and this is key, it doesn't crash right away. Instead, it enters this deceptive period of slow decay. The smart money and the corporate insiders, they realize valuations have totally detached from reality and they quietly start heading for the exits. Meanwhile, debt servicing costs are creeping up. The market becomes exactly like a bicycle losing its forward momentum. It hasn't tipped over yet, but the structural instability is happening right there beneath the surface. And then the momentum finally breaks. Stage 5, revulsion and panic. Some unexpected trigger hits, maybe a massive corporate default or a surprise rate hike from a central bank. Suddenly, all those investors heavily levered on margin get hit with immediate margin calls. They're literally forced to sell their assets to cover their debt. But here's the problem. Because everyone is rushing for that tiny exit door at the exact same time, the buyers completely evaporate. What started as a simple illiquidity problem instantly morphs into a massive, catastrophic solvency crisis. Euphoria turns to pure revulsion, and prices violently overshoot to the downside. Next up, Section 3, History Repeating Itself, featuring 3 centuries of backtesting. Now, you might be sitting there thinking, sure, but modern markets have circuit breakers and complex derivatives. We are way too sophisticated for this kind of thing now. Well, think again. Look at this matrix. We've backtested this across 3 completely different centuries, and the blueprint is absolutely identical every single time. Back in 1720, Joan Law sparked the Mississippi bubble by selling trading rights to Louisiana swamps that literally had 0 gold in them. He fueled it with unbacked paper banknotes, and it ended in a currency crash that bankrupted the entire country of France. Fast forward to 1929. Electrification and the radio were the spark. Leveraging stocks 9-to-1 on margin provided the insane fuel, and it ended in the Black Tuesday panic. And in 2000, the commercial internet. Companies were doubling their valuations literally just by slapping a .com on their name. That ended with the Nasdaq collapsing 80%. The assets change, guys, but the sequence never does. Human psychology is a constant. Moving to Section 4, the complication, the central bank bailout paradox. So what actually happens when the panic strikes and the whole system freezes? This brings us to Kindleberger's most famous policy complication, which was heavily analyzed by economic historian Michael Bordo, the lender of last resort dilemma. Basically, when the market is in absolute freefall, what is a central bank supposed to do? We've got a massive paradox on our hands here. On one side, you have the 19th century Bailout doctrine. This says central banks must act as a lender of last resort to prevent a total economic wipeout. They have to lend freely to solvent institutions against good collateral. But countering that on the other side is the moral hazard paradox. If the market knows a systemic bailout is always coming to save the day, it completely removes the downside risk. This perverse incentive pretty much guarantees that investors are going to take even wilder, more highly leveraged risks during the very next boom. So how did Kindleberger resolve this massive headache? Well, he concluded that a lender of last resort absolutely must exist, or else we risk a total systemic collapse. But he championed this brilliant concept called constructive ambiguity. Basically, the central bank's exact timing and the size of its intervention must always remain just a little bit mysterious. By keeping everyone guessing whether they'll actually get saved this time, central banks instill just enough fear to force responsible risk management. It's the only way to prevent completely unrestrained mania. Finally, Section 5, the payoff, spotting the next market crash. All right, so how do we take all this historical theory and actually apply it to your portfolio today? How do we spot financial distress in real time, before the panic hits? Here is your diagnostic checklist. Rule 1. Watch the credit mechanics, not just the valuations. Bubbles pop when credit tightens and liquidity dries up, so obsess over central bank rates and yield curves. Rule 2. Hunt for negative free cash flow signals. When you see companies burning massive amounts of cash on heavy capex during the euphoria phase, but they have no near-term revenue to show for it, they become as sitting ducks when sentiment shifts. And Rule 3. You have to respect Stage 4. When market breadth aggressively narrows, meaning the average stock is actually dropping, while just a handful of megacaps are propping up the entire index, you are staring at textbook financial distress. Seriously, do not chase the parabolic tail end of a mania. The shiny new technologies we invest in might evolve, but human psychology? That remains entirely constant. Greed will always create credit expansion will always create manias, and manias? They inevitably end in panic. As a focused student of market history, your job is simply to observe where we sit in that sequence. So, as we wrap up this explainer, I want to leave you with a final, provocative thought to chew on. Look at today's credit mechanics. Look at the market breadth. Look at the massive AI and tech narratives right now. Tell me, which stage of the Kindleberger cycle do you think current markets are in today?